now, what's your reaction? I mean, it was 63-36 in the end in favour of passing this bill. It does remove one of the walls of worry, certainly for the time being.
Sure, absolutely. And thank you very much for having me back on the show. Actually, you dragged me away from my desk just as the vote was starting. So I was coming over and I was thumbing it on my iPhone just to see the numbers coming in. So obviously, great that it's now done. Obviously, we can now move on to other things. And that, I think, was, as you say, a wall of worry. It's now out of the way. Let's move forward. Now, let's immediately look forward to the next potential leading indicator, which is tonight, as Kathleen has just been talking about. 195 is the expectation for the jobs data tonight. Let's see whether that may have a bearing on what the rates trajectory is going to look like. The market is sort of wavering around one cut, potentially not in June, but potentially, one raise in July. So that's moving around quite a lot. At Citi, we're basically saying flat from here, and then moving towards the end of the year, we start to see cuts. So market moving around a little bit. Obviously, the jobs data today is very important, but the other part that is incredibly important is that inflation statistic, which you just put up. It's sort of flatlined a little bit over the last few weeks. But if the trajectory is down towards about 3.5% by the end of the year, which is what we're projecting, that may support the case for those cuts coming through by the end of the year. But it is very interesting to note that what was being looked at in terms of cuts, let's say a month ago, which was potentially 2, 3, even 4 cuts by January,
it's been priced out.
That's been scaled back, and maybe it's now only 1 or 2. So this is moving around a lot. So we need to keep very vigilant on all the data that's coming through, all of these moving parts. But at least today, we have some positive. Now, obviously, the Hong Kong market has reacted pretty strongly. That will be a part of it. Yesterday, we had amber rainstorms here in Hong Kong. Today, we've got bright blue skies, and the market's looking a lot more conducive, a lot more constructive today. So let's see how that plays out.
Okay, if we're expecting cuts maybe at the end of the year, which some still argue may still be a little bit too optimistic, I mean, what does that mean for rates then? Are we seeing yields could be heading lower from here, or where?
Well, absolutely, and that is basically what everybody is worried about. And I think one of the things that is very important for our clients is what that means for returns from fixed income securities when we look forward, when we cast our mind forward, not just over the next 3 or 4 months, but 1 year forward, 2 year forward. And our analysis tells us that actually Treasuries should do extremely well when we look forward on a 24-month view from the peak of the rate cycle as we move into the cuts. So we don't wait for the cuts to start, but when we know that they're about to start cutting, then we can increase our allocations of our clients to fixed income, and they can see very good returns, between 15 and 25% returns on a 2-year forward view. For a Treasury, that's a fantastic return set, and when I'm talking to my clients, they are very interested in that. Of course, there's lots of other things to do, but in terms of the core fixed income allocation, rebuilding their core fixed income portfolio allocation, which is what we're talking to them about at the moment, this is potentially an extremely interesting time.